Hey everybody, welcome to my channel. For today, I thought I'll be sharing a bit more in depth on my previous video, specifically around options. Um, I'm gonna slowly walk you through how I generate weekly and monthly income from the strategy I'm gonna cover today. So s- let's dive in. As a disclaimer, I'm not a financial advice. This video is purely for entertainment and educational purpose. So if you are going to do any investment, do it at your own risk, do your research before investing. Here we go. So for today's agenda, I'll briefly cover a bit what are options, um, the two strategy that I use, and obviously give you some real life example as well as the risks and rewards from it. So what are options? Options are contract between two parties to sell or buy an asset at a fixed price. You can be a buyer options or you can be a seller of options. So if you are selling options, you are essentially like an insurance agent or insurance company. You are providing um, the holder of the options or the purchaser of the options the rights to buy or sell an asset at a fixed price, and we call that strike price. If you want insurance, then you are the buyer and you will buy call options to buy the right to buy stocks at a strike price. Or you can buy a put options to buy the rights to sell your shares at a price, right? So I generally prefer to sell puts and call options to earn premium, mainly because of the time decay. So because options has a period of time, and the shorter the time, the faster the premium would decay. So I'll give you an example later on the slides. So we'll go into strategy one. Strategy one is cash secure put. That's essentially selling put options on stocks you want to own. And it's important to only sell put options on companies that are strong in fundamentals, that you're confident in, that are below its intrinsic value. You don't want to sell options that are overpriced because you essentially are buying a company that are overpriced. Um, so to maybe elaborate a bit more, is think of the seller as the insurance company. I'm essentially providing options to a buyer that if the stocks fall below the strike price, I'm obligated, I will buy the stocks from you at that price. So for a buyer, you are worried that because you don't want to hold the stocks, you don't want the risk of the stocks depleting to zero. You want to preserve previous any gains or your capital that you invested in the company. So like if the stocks fall below that price, you want to sell it. You don't want to have any capital loss. So as a buyer of options, you are essentially buying insurance, right? So one thing about com insurance company is that you need to have cash. So the requirement is that you need to have the cash to be able to buy 100 shares of the company that you're selling options to. So if, for example, if I'm willing to buy Google at maybe $100 strike price, so and currently is selling, for example, $120. So I'll sell Google at a strike price of $100 to anybody, within less than 30 days, or maybe what I would do is I'll sell weekly, I'll sell 7 days. That if the price fall at $100, I'll buy the shares. But if it doesn't, I will earn the premium because I'm a seller. The buyer will need to pay me money, and while I'm waiting for the stocks to fall to $100, I will earn premium upfront. Obviously, the risk for me would be that if the stocks drop to zero, I would still need to buy the 100 shares at $100 for the stocks that I want to buy, like for in this instance, Google. So then we go to the next one, give you an example for that. Okay, just give you a real life example of how I deploy this strategy. One expired and one that is active. I sold UNH, which is a legal symbol for United Health, for cash secure put at a strike price at $290. When I sold the cash secure put, the stock is trading about $300 plus. So I sold it for US dollar $100. That would expire on June 27, 2025, and it expired because at the end of the trading day of June 2027, it is trading above $290. So as a result, I earn $100 for 7 days. And if I calculate the rate of return is 18% on my capital. So there you go. If I'm able to do this for every 7 days for a year, I'm able to earn 18% per annual on my capital, which is significant and is more than like your typical S&P without actually owning the stocks. I'll give you another example that's active. I wanted to buy Alibaba because I have not have a full position in Alibaba as of date. So, and it's selling at an attractive price as of now. I want to buy it even cheaper. So I sold a cash secure put on a Hong Kong exchange 9988. Just to be careful, because when you're selling options on Hong Kong Stock Exchange, look at the underlying criteria. So Hong Kong Stock Exchange, like for Alibaba, the options require you to buy or sell 500 shares. So when I sell stocks, like for example Alibaba, one options, I'm required to buy 500 shares of 9988 in Hong Kong Stock Exchange. So if it expired, if the stocks trade below $100, I need to buy the stocks at $100 Hong Kong dollars for 500 shares. So in case, I just want to say that it is a 1 month cash secure put, about 28 days. The potential return on the capital is 13%. So we'll go to the next one. So we go to the second strategy, which is covered calls. This is essentially selling a call on options that you already own and wouldn't mind selling away. Obviously, you require 100 shares of the company to be able to deploy this strategy, and it is an obligation to sell if the stocks hit above your strike price. So it is a strategy that typically I would deploy if the company that I was doing this real strategy already purchased the shares of 100 shares and thinking of like getting my capital back. And it's a way to earn premium upfront while holding the stocks. For example, Google doesn't really pays dividend. I mean, they pay dividend, but it's very, very little. So while waiting and while holding on the stocks, why not earn some premium? And obviously, you want to sell the stocks higher than what you purchased for, and then you will lock in your earning your profits, unrealized profits, and then in the same time, earn some premium upfront. Obviously, there's risk involved in cover calls. Um, the risk would be that if the stocks fall to zero, similar to your strategy one on the put strategy, is that because you own 100 shares, if the stocks actually falls to zero, you lose everything on the shares you own. The other risk would be that you potentially lose money on capital. Let me elaborate a bit further on this. And it's similar to the one that I was referring to in my previous video. I previously sell cash secure put options on Google at $175. In exercise, I purchased Google at $175. While I bought the shares at a point in time, the exchange rate for US dollar to Singapore dollars is 1.34. Singapore dollars has since appreciated against US dollar. And as the result, if I calculate how much Singapore dollars I use to purchase that stock, I'm actually at that point in time using current rate, I'm actually paying a lot more than the current market value, right? So you need to calculate, based on the exchange if you're using any foreign currency other than US dollar to see what are the cost of investment in the foreign currency that you own. Like for example, in my case, Singapore dollar, how much would I need to sell the stocks or the strike price for me not to lose capital, right? If I still believe, if I sell covered calls for 175 and it got exercised, I will get back $175 US dollar, but if I convert that money back to Singapore dollars, I will be getting less than what I previously owned. So that's the reason why you need to consider foreign exchange as well when you're deploying this strategy. Okay, next point. So, okay, let's give real life example of how I deploy this strategy. As previously mentioned, I own 100 shares of Google. So I sold a covered call at a strike price above what I previously bought and also considering foreign exchange. So I determined that a good price for me to sell would be $180. So I sold covered calls on June 26th for $49, which would expire within a week on July 3rd. The stocks expired as the stocks did not reach $180. So I earned $49 US dollar for 7 days. And if you calculate the rate of return is 11% if I exercise this strategy every week for the full year. It's not bad, holding the stocks while earning some cash. But what I'll typically do is once I sold cover calls, I would actually use the proceed to buy the underlying shares. So if, like for in this instance, on June 26th, I got the proceed for $49. I'll use $49 and buy Google, fractional shares of Google at June 26th. It would be trading below $180, so like I could be buying at $175. And if it expired, I will still own the shares, and I will own the shares at a higher price than what I bought it for, right? So that's one strategy I've done. And currently, the active one that I sold today would be to sell covered calls at a strike price of 187.5 today for $33, expiring 7 days from now with a potential of 7.8%. And if you notice, I increased my strike price because I'm able to. I want to be able to enjoy any potential upside. If, for example, the past 7 days, Google actually increased in value, and then I will be able to earn from the unrealized gain that I earned from the shares, and also premium that I got from these cover calls. So this is just a bit about how I deploy the option strategy. You know, please like and subscribe for more strategy. Comment on your favorite stocks below. Um, and thanks for watching the video. Thank you. Bye.